Join us now for more. Jim Paulsen, author of Paulsen Perspectives at Substack.com. Big fan of Godfather 3. They pull you back in, don't they, Paulsen? What happened to? We said goodbye. We need to take that all back. Just couldn't. Couldn't stay away.
Once you got a hobby for too long, Joe, you can't stop.
Right, exactly. Woody Allen talked about that. Now you're knocking my hobbies. We saw 24% last year. We got 15% in the first half of this year. You were one of the few people that were pretty friendly towards the market all last year. How about after what is that, 24 plus 15? That's like 40% in a year and a half. More to come?
I think so, Joe. We're still up 15% from its high at the in the market in the last cycle before we had the bear market in 2022, which isn't a lot. That's 2 years where we've gone up 15% from that high, if you will, overall. I think this bull has been operating on less support than it normally has, Joe, and it's because the Federal Reserve has opted for this very unique policy cycle. This is the only bull market in post-war history that has existed entirely under a Federal Reserve which is tightened throughout its entire existence. That's never happened before. Usually the Fed eases rates before a bull even starts and eases in a good part of the early part of a bull market. This one got nothing but tightening. And the result of that has been, I think, a very narrow bull market because a lot of its supportive pieces haven't showed up yet. All the market's really gotten so far is disinflation, which has been very beneficial in helping the economy and the market go up, but it's missing a lot of other pieces that could come if the Fed eases. The big one, of course, is lower bond yields and lower interest rates, but also if they ease, monetary growth will pick up. It's been negative most of the time in this bull market year-on-year growth, but if liquidity starts to improve, that's a big plus for the market. And then lastly, confidence would increase. Consumer and business confidence would increase, which also typically is associated with bull markets. And I think because it's lacked these other catalysts, it's been a very narrow advance. So if the Fed does finally declare victory on inflation here, which I think they're gonna, and we do cut rates, then I think we're gonna see a lot more stimulus come for the stock market, and we kind of might have a move that looks a little like the start of a new bull market that we never got in this cycle yet.
The rise in rates orchestrated by the Fed didn't come till after a couple of crazy things, unprecedented things like the pandemic and like staying at zero for like 6 or 7 years. So, I mean, there's a lot of liquidity just built up from that. And maybe they did go up 500 basis points, but you look at, we keep hearing how much money is ready to go into the stock market, Jim, whether it's from the Fed or whether it's from all the stimulus that came even after the pandemic was over. There's $6 or $7 trillion laying around ready to come in. So it all does play into what you're saying, but it just doesn't seem like it's organic liquidity. It seems like it's faux $33 trillion in debt liquidity.
Well, I think that one of the things that makes me feel pretty good about this is that the economy, to me, I think still not likely to fall into recession anytime real soon, Joe. And the reason is because the private sector is pretty healthy, really. And a recession needs vulnerabilities in order to bring the economy down. And I just don't know where they are. The balance sheets of the household sector are very strong. Debt-to-income ratios have been falling for years. Debt service ratios almost at a record low. Real wages are going up. Job creation is still happening. Net worth to disposable incomes close to record highs. The corporate sector similarly in really good shape with low debt-to-equity ratios and high net cash flow to GDP ratios. Corporate profits are at new high. I don't know where the recession is going to bite to bring this thing down without the vulnerability.
That could all be